Hey y'all, welcome back to the channel. Today we're talking about Rumble stock. Whoa, I know. Come back. Before you click off, give me 60 seconds to explain. I promise it will all make sense. I'm Brian, flying solo today. Tom's off doing Tom things with his Tom people making Tom faces. But I've got the breakdown on RUM for you today. If you're watching this on Rumble, well, you know. But if you're on YouTube, Rumble is a competing video platform that is starting to make a dent in the industry. Stick around because we're breaking down the financials, boring, those wild partnerships, and whether you should add Rumble to your portfolio. And hey, if you're new here, smash that subscribe button and leave a comment below. Just your favorite emoji if you want. If you got nothing better to say, hey, it's all engagement, right? All right, dudes, here's the story. Rumble's like Rocky Balboa in the movies. You know, he starts off small, goes through a training montage, and before you know it, he's throwing punches with Drago in the main arena. Well, right now, Rumble's in the training montage spot, so hopefully they can get to that main arena. So let's start with our market cap. They're around 3.1 billion as of October 2025. Revenues exploded from 9.5 million in 2021 to over 104 million in the trailing 12 months. That's growth, but I don't necessarily think it'll make your dividends jealous. The EPS is negative 0.12, so that's not great either. They're burning cash like I burn through bad video takes. Their fundamentals, well, it's a volatile stock. It's got big dreams with even bigger losses. It's a high risk, high reward growth stock. And yes, I know we're the dividend dudes and we like those juicy dividends and passive income, but we've never said that we're against growth stocks. And since we're getting dividends, we're going to use those to put those into these risk plays. It's the house money. As far as their user base, they're up to 51 million monthly users. That's more people than a Taylor Swift concert. So let's crack open the boring income statement. Revenue's up. Q2 2025 hit 25 million, growing 5.8% quarter over quarter. From 2021, it tripled. Things like ads and Rumble premium subscriptions, the data center cloud stuff, it all added to that, and they're diversifying faster than my fantasy football team. But the cost of revenue is eating them alive. 127 million against 104 million revenue. That's not great. The gross profit, negative 23 million. It's like buying a Ferrari, but forgetting you have to pay taxes and insurance and gas money for that thing. Operating expenses at 97 million, leading to a whopping net loss of 301 million. The EBITDA is negative 106 million. If this were a teenage girl on a dating app, well, I think she'd be swiping left, but we're not just yet. Let's see if the balance sheet has anything better to say. The total assets for Q3 2025 were 380 million, up thanks to free cash infusions. Liabilities, 66 million. Equities bounced back to around 314 million after going negative in 2024. That's at least a positive comeback story waiting to happen. Debt's low, just 2 million in leases. No big loans hanging over their heads, but working capital was negative 81 million last year. Their liquidity, well, they've got cash, but they're kind of walking a tightrope. The tangible book value is negative, and tangibles from deals are propping up this stock. Now humor me, if Rumble's balance sheet was a dude at the gym, I think it'd have big arms from assets, but they skip leg day on equity. You don't skip leg day, people. Leg day matters. So what are the risks? There are unfortunately many. If funding dries up, poof. I mean, that's it, game over. But with that cash pile, they've got about 4, maybe 5 years runway. If they make smart moves, they could keep it trending higher. The cash flow, you know, where the rubber meets the road, that all-important operating cash flow is negative 62 million. They're spending to grow, so that's kind of to be expected. Their free cash flow improved 47% in Q2, but still negative 65 million. Investing outflows, that's 27 million on AI and cloud gear. Their financing, well, that's at least a boom, 220 million inflows, mostly from that Tether mega investment. And cash is a whopping 284 million. I mean, that's a pretty big buffer. But burn rate means they need to hustle. They need to start making a profit as soon as possible before they run out of that cash. Imagine if dividends were flowing here. I mean, they'd be out of money. For now, it's in growth mode, and we love that. They need to scale users, they need to cut costs, and make an actual profit. Now, the juicy part. Here's the good and the good, bad, and the ugly. Those acquisitions that aren't really acquisitions, but game-changing partnerships. First, the Perplexity AI hookup in October 2025. The stock popped 9 to 16% on that announcement. The direct effects? AI search on Rumble boosts video discovery. So if engagement's up, maybe 10 to 20% more time on the site, that means more people watching. That means more people staying on the site, which means more ads. They're also going to bring some more bundled subs. And if I could say this right, the Perplexity Pro plus Rumble Premium bundle is coming. So that takes their AI and puts it into a bundle for you. Hopefully that gains more money as well. Rumble's guidance is calling for a revenue bump incoming for Q4, which is 5 to 10% growth. Future user growth, they're expecting 15 to 25% in 2026, and they're hoping for less ad dependency. But the cost to integrate equals major short-term pain. It's like adding steroids to your workout. You get some good gains, but man, watch those side effects. The risks, if AI flops, they're not just back to square one, but they're falling hard. We're still bullish because their partnerships, they align with their anti-big tech and free speech vibes. Their overall strengths, cash from Tether, AI crypto diversification, and the user boom. Their weaknesses, of course, are their major revenue losses and a high profit to sales ratio at 30 times. The outlook, we're putting our dividends into it. We're letting the house money play this bet, and we're expecting to look 3 to 5 years out. If partnerships deliver 20% plus revenue in 2026, that price target could be around $10 to $12 per share. So we're monitoring Q3, Q4 earnings to see if they keep on track. Hit like if this kept you glued, subscribe for more passive income, and let's make that money work for us. Thank you for watching, and as always, happy investing.